The Fed is going to cut rates tomorrow with the stock market at record all-time highs. How has this historically impacted the stock market? Do stocks continue to melt higher, or do they have some sort of sharp reversal? We'll talk about that here in today's video, as well as if you do get a sell-off in stocks, which ones could be potential stocks to pick up on a dip. I'll be sharing my personal opinions in this video, as always, not financial advice, sharing this for educational purposes only, and if you enjoy it, make sure to subscribe. Let's jump in. So for this historical study, I just wanted to start by taking a look at some historical instances where the Fed cut interest rates and the stock market's overall reaction. Now, what you have here in white is the Fed funds target rate. And of course, this is essentially what the Fed is doing. If they're cutting rates, if they're hiking rates, this line goes up. If they're cutting rates, it goes down. And then of course, we have the SPY here overlaid on top of it. And of course, last year, we did in fact get the Fed cutting interest rates, and then we went on pause. And of course, tomorrow we are expecting to see another rate cut and perhaps another series of rate cuts. But the question is, will it be as docile and actually positive for the stock market this time around? Well, let's take a look at historically what happens if you start to see multiple cuts in a row. So going back to 2019, actually before the pandemic, the Fed was actually cutting interest rates, and we did see sort of a choppy back and forth market before ultimately a pretty sharp sell-off during COVID. Kind of funny to think the stock market sell-off, which was so crazy at the time, is now just a quick blip on this chart. But we did see in that instance, sort of once the Fed started cutting interest rates, some initial push higher and then a spike lower. What we can also take a look at is, for example, a nasty example, which would be the 2007 into 2008. So in 2007, the Fed was on pause and then eventually started to cut interest rates actually before the market started to really sell off. And this was actually a very nasty drawdown in stocks. In fact, stocks across the index level lost more than half of their value. Not to mention individual stocks completely went to zero. Scrolling back further, we can take a look at 2001. This was the dot-com era where people were hyped up about the internet, and some people like to draw the conclusion that it is similar to today's market. I would argue there's a little bit of difference in the sense that dot-com stocks didn't make money, and now AI stocks make a ton of money already. Anyways, let's take a look at what happened here. So they were hiking rates into, the years preceding, and actually the market moved higher alongside the Fed hiking rates. And then they started to cut rates and the stock market sold off. Now, what's not completely fair about what we're doing here is we're looking at some of the recent examples. And I should say recent as in the 2000s. There were several instances before this where the Fed cut interest rates and the stock market continued to rip. Specifically in the 90s, we did see the Fed cutting interest rates, and as they did that, look what happened. We entered into a massive melt up for years to come. And so please understand, it is not as black and white as saying if the Fed cuts, the stock market crashes, or if the Fed cuts, the stock market rips. There's nuances, and that's why trading and investing is difficult. It's not always quite exactly the same. But what is my opinion on this situation? Well, my opinion on the situation is that we have got a little bit of trickiness in the jobs market. And that ultimately is why the Fed is cutting rates, in my opinion. Taking a look at the macro screener within the stock box, we get a better picture of what we're talking about. Jobless claims have been weak, JOLTS job openings have been weak, ADP numbers have been weak, and the non-farm payrolls have been weak. This suggests that stocks are not necessarily super attractive based just on the macro when we look at our set of metrics here. Now, of course, there are some green spots as well. We can see retail sales this morning came in better than expected, GDP growth has been upbeat, and services PMIs were strong. So there's some positive, some negative in this mix. Long story short, nobody knows exactly how the market will react to rate cuts. But in my personal opinion, the risk to reward, as I've been saying many times on my channel here recently, is not great up at these levels. So let's talk more constructively. If we did get a sell-off in the stock market, would that opportunity be a buy the dip? Well, in my opinion, the answer would be yes. If you actually get a good size sell-off as people panic about the labor market, then you might be talking about an opportunity to step back in where the risk actually meets the reward, or actually the reward exceeds it. And I should say the reward potential. Ultimately, if you do get some sell-off in the stock market, it can be very quick. And tomorrow is expected to be very volatile. Just take a look at the VIX, which is on the rise here in the last few days, as the options market is saying, okay, we're gonna get some movement tomorrow. And I also wanted to take a look at our top sector screener on the stock box to get an idea of which areas of the market I might be more interested than others if we do see a slide in the markets in the next few days. The XLF ETF is the financial services ETF. Let's take a look at that, as it's getting the highest score within the top sectors page. And here's a look at the XLF ETF, which is, of course, like I said, it's a basket of financial stocks. What I like to do with my chart markups is to mark specifically on an RSI 4 period, which people ask all the time. It's a 4-period RSI that I use. Nothing magical here, but it helps me to draw support and resistance levels. What I'd specifically be looking for with tandem, of course, with the scoring within the stock box, is to look for instances previously where this had actually started to get oversold. And so what we saw here is we saw a really sharp reaction around the 5150 level. And so this would probably be an area where I'd be interested in possibly buying the dip on XLF from a bigger picture. So I do really like this as a trading opportunity. If you were to see a pullback, financial stocks might be attractive, especially as the Fed cuts interest rates, which is really attractive for banks who play sort of the borrow at the short end and lend on the long end of the curve, right? So loans, they can borrow at lower rates and then lend it out at higher rates, which is sort of favorable towards them. So I do really like financials if they were to get a larger pullback, like I said, around 5150.
Did you know that we have 100% free trading tools and data available for you on our website, a1trading.com, right now? We have free courses for you to browse. You can also check out things like retail sentiment and free articles from our analyst Frank that include things like Edgefinder screenshots and trade setups. You can find all of this and so much more for free right now on our website, a1trading.com.
And I can actually take a look at some individual stocks within the top stocks watch list, and I can filter for financial companies to see which ones look most attractive. Specifically, MasterCard, SPGI, Visa. These ones are getting our highest scores currently. Let's take a look. Here's a look at MasterCard, which is getting the highest score. We can do our similar concept where we're looking for oversold readings here. That sort of marks up this area of support as a possible area of interest if we do continue to see the market slide. We also saw Visa, which I actually think is a longer term decent company to own. So what we can do here is we can also mark up our levels of support that are obvious on this chart, and this area around 335 near current levels doesn't look too bad. So you actually have kind of what I don't love about this chart is you do have sort of a lower high sequence, but there still may be a good buy the dip opportunity here. I would prefer to see if we get a slide on Fed Day, as if you do sort of see this kind of move, I would love to potentially buy some shares of Visa. Another area of interest would be real estate. XLRE is an ETF that tracks the real estate as a group as a whole. Taking a look at the sector ETF, we can see this one has actually been consolidating, but lower interest rates in an environment where the economy holds up could be a huge payout. And of course there is an if there, right? If the economy holds up. If you see a slide to the downside here towards the bottom end of this range, this potentially looks like a good opportunity for me personally. So I'll watch for a buy the dip opportunity there. And if we repeat the process to take a look at some individual stocks, let's go back to our top stocks algorithm and filter specifically for real estate stocks. AMT is going to be your highest score here currently on the stock box. And what this means, by the way, I should explain this a little bit more. This just means that looking at technicals, sentiment, and company financials, AMT is getting a relatively strong reading. And so if we take a look at AMT, what we can see here is the stock has gotten kind of beat up. What I'd personally prefer to see is momentum start to favor the upside a little bit more. You can see momentum specifically is getting a -2 reading on the stock box, so not a particularly attractive one for me. So I'll probably skip this one. I'd like to see this thing start to put in some sort of higher lows, higher highs, just some upward trend. I typically do prefer to buy stocks that are trending up. Not always, and there are exceptions to the rules, but tend to prefer to buy momentum stocks, which is why it is filtered into our technical reading screener here. Here's a closer look at MA for MasterCard. What we can see here is that the stock is still not necessarily cheap per se, but we are getting some decent readings on revenue growth and earnings growth. PE ratios around its 3-year average, same with its forward PE and trailing 12-month PE around its 3-year average. So I don't think you're getting necessarily a bargain on MasterCard even with the dip. But if you were to see a slide tomorrow or in the next few weeks, this could be an opportunity to start seeing those PE ratios come down, get a little bit of a better price relative to its 3-year average, starts to become attractive on the stock analyzer page. And by the way, if you're interested in getting access to the tool that I'm using, it's called the Stock Box. And our team here at A1 Trading works tirelessly at building tools like this to continuously help traders to find better opportunities. So if you're interested in scanning financial data, technical data, sentiment data, and much, much more, check out the Stock Box. There will be a link in the description down below. And if you send us a direct message using the first link there, then you can get access for a huge discount. We'll give you an additional discount if you message in on our website. Just let them know you were watching today's video, and they'll definitely set you up with an additional 5% off. So it'll come off to 45% off for a limited time. Here's a bit of an update on my Tesla play, which has been really good. The stock completely exploded to the upside, and it looks like I'm likely to, depending on what happens in the next few weeks, get called away from at least half of my shares. I sold 2 contracts at the 355 calls and 2 contracts at the $400 strike price calls. The thing is, I own 400 shares of the stock. So this is called a covered call position, where essentially I'm long the stock and also sold calls against it. So here's a closer look at the position that I have. So the 200 shares and 200 shares. So I have a total position of 400 shares long the stock. I'm up about 77% on those shares that I own. However, I also sold the 17th of October calls against my shares. Now one with a strike price of $400 and one for a $355 strike price. Now you can see that the calls are in the negative. So the calls that I sold are hurting my performance, whereas the long the stock position, of course, is helping significantly. Overall, between all the options and stock that I own, the trade is up $56,000, and I'm looking to take profits on this move. When Tesla sold off big time back in April, I thought it was overdone. And this is an example of where a high risk bet can pay off really big, because the thing is, Tesla is a high risk stock. It's a very speculative name, and I bought it during what looked like the end of the world during the April sell-off, because everybody thought trade wars were going to go for the next 5 years, and that's going to be terrible, and the economy is going to crash. And I did not think that that was likely to resolve that way. I also like the innovation at Tesla and do like the long-term vision of some of the things that they're building. However, from a trading perspective, I think the stock has popped, and we also have some real uncertainty when it comes to the financials of the stock. When we look at Tesla on the stock analyzer tool, you can see that most of our metrics, almost all of them, are red. What that means is that the stock is just straight up expensive relative to its own history. The PE ratio is very high, especially against the auto industry, right? Very low PEs, but there's Tesla with 169 PE. 244 PE, but a forward PE of 169, right? So we have these very, very high valuations on the stock. And the earnings have not been there for Tesla. Let's take a closer look. So here's a look at the income statement for Tesla. And what you can see here is in the last few years, earnings have been falling and revenues have been flat and now falling. So this is the challenge. If you're a Tesla shareholder, like I am currently, you are not buying it for the financials, because the financials, let's face it, have been horrible. They've been really ugly, right? Sales declines, revenues declines, net income declines. It's been not pretty. The positive around the corner that many investors are hopeful for is robotaxi being released and being a game changer, and they're going to take a huge market share. The revenues are going to skyrocket, and so will the net income. That's one of the big stories around sort of the next few years for Tesla. There are many other reasons, and by no means am I, bearish on the innovation at Tesla. But in terms of financials, it's really hard to defend the stock, at least looking backwards. Looking forwards, you might say, well, they're going to in the future do this, this, and this, but that is speculative, and it's a different type of investing than investing or trading stocks that have the growth right now, right? So Tesla, which previously in its past has been considered a growth stock, it's hard to justify it being a growth stock when it doesn't have the growth. It's more, I would say, it falls into the category of speculative stock. So yes, I own shares, but it was mostly for a trade, and I'm looking to take profits on that trade. I've done really well with it, and I'm happy to let go of the stock and just call it good. But however, it actually has the potential to pull back. And today on the live stream, I had a conversation with Chris Pulver a little bit about Tesla, how basically I could still stay in the position because we still have time on those calls. Now, if the stock just parabolically goes up from here, then it will be likely that I'm called away. But check out this quick clip that Chris Pulver and I discussed during my live stream here this morning.
Yeah, I've actually been dabbling. So I've had a pretty nice pump on Tesla, which I'm sure. I mean, that's a
Oh
pretty
yeah, me
actively
too.
traded thing for a lot of people. But having that rip from like 350 to 415 has been pretty nice.
I
I'm
sold the
eyeing all-time
400
highs.
calls, Chris.
Did you? Okay.
Yep.
Well, don't feel bad because I'm selling, like 320 and 325 calls that I've been buying since the dip at 240. So
Yep.
I'm, $100+ in profit in the money, and now I'm just going to roll those calls and keep, getting whatever income I can get, a couple bucks a week or
Mhm.
so. But I do have some ratio spreads. I do have some, some naked puts and some other things that help me make the income as this is getting further and further out of the money. But I like the run to all-time highs. I think, it looks a little, it looks a little iffy, but I think it's a bull flag unless it's a run up to pullback right away to 360 again or 355. I think we just, we rip up, we base, and we're probably going to try to stretch to 480. Timing wise, I mean, if I'm doing anything on Tesla, any dips, I wouldn't mind getting some additional exposure to it. But I mean, highs at 483. We've seen mags continue to make all-time highs. I mean, look at mags. It's like it won't
Mhm.
stop. It is wild, dude. It won't stop. This market won't stop. I think any dip, it just depends on how ugly and how violent. But it's like the retail crowd is just insatiable by the dip. Tesla, of course, playing a big catch-up game. And I don't know if this is all because of Musk buying $1 billion worth of Tesla stock, or just it was. I thought the pattern was due. I mean, I look at this chart
It's been
and
going
saw this
nowhere for a long
as a
time.
potential neckline, as a potential wedge, as a potential coil. And this breakout is just letting the energy go somewhere. So now we look left and find all-time highs. So
Yeah.
both like would be great.
On Tesla, so Tesla for me is was probably my best trade this year. I ended up buying Tesla. I bought shares back in the April sell-off. I mean, I literally got pretty close to the bottom, and I've been selling calls along the way, and I finally am going to get called away. And honestly, I'm not mad about it at all. It's not a company necessarily that I just want to park and hold forever.
You might not get called away.
I might not get called
$400,
away.
it might have a $15 pullback, and you might be fine.
Yes, it's true. And this goes out to October. So, I mean, I got time. So it could
You
either
got time.
keep going or it could, but
Yeah.
either ways, the premium on those things are insane. I've done actually decently well. I pretty much sold calls the whole time. I've been getting truly into the tasty stuff. So I've been, doing the 45s, selling or rolling at the 21s for the most part. So I've been pretty standard, tasty option strategy, but not the strangles, just covered calls on this.
Sure.
But anyways, I also wanted to just illustrate, because you've highlighted some stocks. I know not everybody in the audience, you may not trade stocks, but watch stocks, even if you don't trade them, because they give you an idea of market sentiment, right? If you have some of these high-flying names like your Googles, like your Teslas going crazy, it tells you a little bit about market sentiment. However, we got to balance it out, because the AAII Investor Sentiment Survey, you pointed to something, Chris, that I thought was interesting, which is you still have sideline bears. And sideline bears, the tricky part, I wish they would just go ahead and buy, because that would give me more confidence that we're actually going to see a potential pullback.
I think this is the pain trade. This is the pain trade.
This is the pain trade right here, because you still have 50% of respondents here on the AAII Investor Sentiment Survey. This surveys a bunch of people about their perspective on the stock market going forward the next 6 months. The biggest chunk of this, people are still bearish at all-time highs. We take a look at the put to call ratio. This is always an interesting one, a little bit neutral, but you still have almost a high reading on the put side. So the thing is that what makes this tricky is you still have bearish sentiment. Take a look, for example, we could take a look, another indicator. You have the Bitcoin to gold ratio trending lower, right? Suggesting some more risk off dynamics, right? So we have this situation. And just to finish our sentiment study, here's SPX. To your point, Chris, we still have hedge funds with pretty large short positions. When the market gets when institutions get really bullish, they throw off their hedges, they just go full long. Because again, we know that they can balance their positions a little bit by buying, shorting SPX futures while also holding stocks. So that's one of the tandems with COT data history. But typically, if they're super bullish, you might see those hedges come off. Right now, we still see some pessimism in the institutional level on the SPX. NASDAQ slightly more favored towards the long side, so just worth mentioning that. But yeah, I mean, that's the thing, is there is some room, in my opinion, to still see the stock market do a little bit of a melt up thing, because trying to time this top is so difficult. That is why I've just not been on that side of, okay, I like the idea of waiting for dips, but You may not get them, and I'm not going to try and fight if you do get that momentum to the upside.